Hello, my name's Craig Earl, I'm market analyst at ALPARI UK, and welcome to our daily market update. Today we're going to start by taking a look at the Fed press conference yesterday. Now this followed the two-day meeting, and you tend to get a lot of volatility at these meetings. You tend to get a lot of volatility really anytime Ben Bernanke speaks, but we didn't really see that yesterday, and the reason was there wasn't really any surprises that came from this meeting. We saw Ben Bernanke address the fact that the US contracted by 0.1% in the fourth quarter, saying that he thinks it's just a temporary blip. He thinks the US will recover from this, although there remains a lot of downside risk to the US economy, so he used this as an opportunity to reaffirm his commitment, reaffirm the Fed's commitment to those low interest rates until we see unemployment fall to 6.5%, which is expected around the middle of 2014, but also reaffirm the Fed's commitment to the $85 billion of asset purchases every month. Now, this is the part that we did see a positive reaction to in the markets, given the fact that there were some board members actually concerned about the impact of these asset purchases on things like inflation from the minutes in the previous meeting. So the fact they did reaffirm them, we did see that positive reaction in the markets. It would suggest that we are going to see the continuation of this liquidity-fueled rally in the equity markets, and therefore, like I say, we've seen that positive reaction for all those traders who have got on board this equity rally so far. Today, I think we're going to see the focus remain on the US. We've got some key economic data due out this afternoon. We've got the initial jobless claims, which are expected to come in at around 350,000. For the last couple of weeks, we have seen that number drop towards that 330,000 level, the lowest figures we've actually seen in 5 years here. I don't expect to see it actually remain around this level. I think this is just a temporary blip. We do tend to see some volatile figures here in January. Like I said, I think we're going to see it move back up towards that 350,000 level, which is still low compared to the average over the last couple of years. I think if we do see it come down around that 330,000 level again, this will suggest that we may see a new norm forming in these figures. We may see a lower average forming, which is optimistic, especially ahead of the jobs report tomorrow. Also today we're going to have some more corporate earnings, and there's not really any companies in particular I want to highlight, but there is a large number of corporate earnings, so it's certainly worth keeping an eye on those figures, keeping an eye to see if we continue to see companies beating expectations. As I mentioned yesterday, we've currently got more than 2/3 of companies beating expectations, which is continuing to fuel this rally. Finally, like I say, we've got the jobs report tomorrow, and again, I'm not going to go into too much details at this moment, but we are expecting non-farm payrolls to come in around 160,000, with the unemployment rate either staying at 7.8%, potentially creeping higher towards 7.9%, due to the fact that we tend to have that seasonal temporary hiring at Christmas, which is obviously coming to an end in January. Finally, just a brief look at Europe this morning. We've had quite a few pieces of economic data out, but we've had very little reaction to this, and the reason for this is we do tend to see that period of calm in the lead up to the US jobs report. Like I say, that non-farm payrolls figure really is seen as the key indicator for traders about the state and the health of the US economy, so we do tend to see that period of calm in the lead up to it. Just a couple of pieces of information from this morning which I think are of note was the German unemployment figure. Now this fell to 6.8% in December, the lowest figure we've actually seen for a while, down from 6.9% as well, which is where we were expecting it to remain. So we did see a positive reaction to this. It would suggest that Germany won't fall into recession in the first quarter this year, despite contracting in the fourth quarter of 2012. We also saw retail sales fall by 4.7% in December year on year. Now, this was a slight concern in Germany, but given the fact that we did see it contract in the fourth quarter, it's not too much of a surprise. But one thing of note was the fact that it is the lowest year on year figure since March 2009, when Germany was in the deepest part of the recession. Finally, if we take a look at the cable chart today, we mentioned previously that double top formation on this chart, and we said if it breaks below that neckline, we should see a break towards 153.50 based on the size of the double top, but only if it actually broke below that long-term ascending trend line dating back to January 2009. What we actually saw was we saw it find support from this trend line before trading higher, and I think the key thing now we should be looking for is to whether it breaks back above that neckline. If we do see it break above the neckline, this would be relatively bullish for the pair, and we could see it move back towards 159.50, which is the 38.2 fib level, but also that previous level of support. If we see it find resistance from this neckline, then I expect to see the pair have another assault on that ascending trend line, and if we see it break through here again, prompting that move back to 153.50. For more news and analysis, check out the ALPARI newsroom, which can be found at www.alpari.co.uk/newsroom. And you can also follow us on Twitter as well. My username is Craig_ALPARI UK, and there's also the ALPARI Twitter feed, that's ALPARI UK Forex. Thank you very much for listening. My name's Craig Earl, I'm Market Analyst at ALPARI UK.